Corporate finance practice problem using Excel. 7-year MACRS depreciation, 10-year cash flow, and net present value calculation. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information, left-hand side, populating that into the blue area on the right-hand side. Another comprehensive problem. Going to pull in some of the factors that we've looked at in prior presentations. Putting down an initial investment on a fixed asset. This is going to be cash going out, $300,000, in order to receive the inflow of cash below that we are expecting or hoping to receive. Then we have the tax rate of the 35%, the cost of capital, 15%. So we want to think about what the tax implications will be related to depreciation. We're going to consider MACRS depreciation to get an idea of the type of depreciation in the tax code, because when we put depreciation in place, remember that we're talking about the tax impact of it rather than the book depreciation, because really we're thinking about a cash basis system when we're trying to do the present value valuation to determine whether or not to put money in. But the tax depreciation has a tax effect, the depreciation having a tax impact. That tax impact is cash related, and therefore it greatly complicates our problem here to try to figure out that tax effect, because it can be significant. So we'll add that, and then we'll think about our cash flows, and then we'll do our net present value calculations. It's going to be great. So we're putting money down. We're buying the equipment, the $300,000. This time we're going to just name it as 7-year MACRS fixed assets type of depreciation. Once you know that, then you got to project or think about what the depreciation will be on it, which typically you could find in the tax code, of course, but knowing that the tax code could change from year to year, so there might be like bonus depreciation or 179 or some kind of change they might put in at any particular place, which we wouldn't know about because we're trying to project into the future. We can try to figure it out. But the bottom line tax is basically MACRS, which is a form of double declining balance. Double declining half-year convention is the general rule. You can then go to the table. You can look at publication 946 on irs.gov, the IRS website, irs.gov. And this is table A1. You can look at the 7-year property and look at just simply the rates on it. I'm going to calculate a double declining half-year convention in our worksheet, which may be close enough to do most estimates with, since we're doing projections into the future. And remember, you got to take into consideration any other kind of bonus depreciation that could be in place at any particular year you're putting this in place on. And then we'll work it there, because I think it's useful to understand kind of what the kind of depreciation is for the tax code, which is a double declining half-year convention generally, but then modified, because taxes have to be very confusing. So we're going to say then, let's do this for the cost. For the first year of the depreciation, it's going to be the $300,000. That's what we're putting down for this piece of equipment. We're going to say that the years is going to be 7 years, because it's 7-year depreciation for MACRS. Going to underline that. That's going to give us the straight line dollar amount. I'm going to call it the SR depreciation per year, 300,000 divided by 7. Then we're going to compare that to the cost. So we'll compare that to the cost of the 300,000, underlining that, font group and underline. That's going to give us then the straight line percent, the SL straight line percent. Starting point typically for thinking about depreciation, dividing these two things out. We then have the number group percentifying it. Let's add a couple decimals. We're at the 14.79 about. You can also get there by just saying this equals 1 over the number of years, which is 7. That's the easy way to do it, but not quite as intuitive, I believe. Then, once we have that percent, we're going to say times 2, because it's double declining. This is the double times 2. This is the double declining component, that 2 double in it. Hence, double declining balance. That's going to give us the double declining percent, the double D percent. Sometimes you'll see it referred to as 2 capital D's, double D percent. And we're going to go percentify that, add a couple decimals. Then we'll take that times the cost now, which once again was the 300,000. Underline that, font group underline. And then that's going to give us the depreciation, the double D per a year, which would be the 28 something times the 300,000, which would be the 85,714 about. But because it's the first year, we have a half year convention, meaning we kind of think about this thing as if it was bought in the middle of the year exactly, even though it could have been bought like at any point. Even if it was bought in January or December, there could be exceptions to the rule. Again, if you bought everything at the end of the year, you could be an exception. But for the most part, half-year convention. That's what we're assuming here. Bought in the middle of the year is the assumption for the tax code in general, as of now. Well, the general rule. Dividing this out, that's going to give us the 42,857, which looks just like the straight line method there, which it is. And you might say, why didn't I just stop there? Because this isn't the straight line. It's double declining half-year convention, which is totally different, even though you get to kind of like the same number oftentimes for the first year. But it's different because like when you go to the next year, it's going to change. So you don't want to think about it as simply straight line because that'll mess you up. So next year, in the following year, we're going to say now where we're at is the 300,000 minus the 42,857. That's kind of like the book value, you know, the tax depreciation book value, meaning the cost minus the accumulated depreciation thus far. The percent will remain the same, numbers group, percentify. And then I'm going to underline. We're going to say underline. And then we'll say that this is going to be the 2857 times that number. And there we have it. No half-year convention because this is a whole year. No. So then that's that one. Let's do it again. Do this again because it's good times. Number group, percentify, add a couple decimals. Then where we were last time, minus the last year depreciation. This is where we at in like the book value, cost minus the depreciation for tax purposes. And then underline, multiplying this out. And there we have year number 3. Same thing on down because there is no half year. This is a whole year again. Let's do it again. Let's do it again. Number group, percentifying it. Where we're at last minus the depreciation. There we are, underline, font group, and underline. Multiplying this out. Multiplication. There we have it once again. All right, and then another time. Let's add some decimals here. We're going to do it another time. Here we do it again. And I could do this all day long. This is just spectacularly fun and exciting. 131,195 minus the 37,484. Underline in that, font group underline. Multiplying this out, multiplication. And there we have it. And then we're going to go then to the next one. Now the next one, the next three, the tax code, you could keep going with this double declining and then kind of like the plug at the end of the year. But we'll try to mirror the tax code a little bit. If you look at the 7-year, they kind of deviate a little bit on the percentages. They basically start to even everything out at the end of the year right here. So I'll do the same thing and we'll do something similar on our side. Again, you could use these percentage rates and just do it that way, but I think it's nice to kind of get an idea using the actual calculations here of what the tax code is doing. So we're gonna say, I'm just gonna say this is the same for year 6, and we'll underline that and say we'll just pick up the same there. And so this is going to be, I'm sorry, hold on a second. This will be this minus this, but I'm not going to multiply it times the percent. We're just going to say it's the same amount. For this year, I'll do the same thing over here. Now we're at the 66,936 minus the 26,775, but I'm not going to multiply it times the percent. I'm just going to use the same number here, and then the last year will be the plug. We're at the 4162 minus the what should be here, which would be the 26,775. So we have the 13,387 left, 13387, and that will then be the end result. Hold on a second. We have, yeah. So let's double check it. If we add all these up, if I sum these up, they add up to 300,000. There's the 300,000 there. So it works out after 8 years because it's 7-year property. with the half-year convention. So now that we have that, we can think about our cash flow with the tax impact due to the depreciation. So let's think about the tax impact. So we're going to say, all right, we'll do this faster because we got a lot going on here. I'm going to say the earnings before depreciation and taxes. Let's just bring this on over. This is going to be the 100. And then I'll say tab. I got to move sideways here, so it's kind of tricky. I'm going to put this one tab, and then I'm on number 3, and this one tab, and then number 4 is going to be this one tab, and then number 5 is going to be this one tab, and number 6 is going to be 70 tab, number 7 is going to be the 70 tab, and number 8 is going to be the 70 tab, and number 9 is going to be the 70 tab, and finally, numero 10, that's how you say it. All right, and then we're going to say that's going to be depreciation, which we'll just pick up from our table over here. That's what we just calculated, the depreciation. Now, the depreciation only goes out to year 8. So we don't have any depreciation after that because it's fully depreciated, even though we expect the revenue to keep rolling in after that point. That could well be the case because the depreciation for taxes does not rely on us trying to depreciate over the useful life per se. We just use whatever rule that the government gives us to depreciate it. So we're going to bring this out to period 8. There is no depreciation for 9 and 10, even though we still have cash flow that we believe is going to be generated from this piece of equipment or whatever the thing is we're buying that it's gonna make us money. I don't even know what it is, but it's gonna make us money. I'll tell you that. That's the plan. Home tab, font group, underline. So then we have the earnings before taxes is gonna be equal to the 100,000 minus that 42,857. Let's copy that, Control C, and paste it on down all the way across. Oh, I messed up. Hold on. Try it again. Another time. Paste it again. There. That time I got it right. I get it right once, like if you give me at least 3 shots, like one of them, usually I get it right. So I'm going to pick up the 57,143 times the tax rate, which is over here. 35% on the tax rate. I'm going to select F4 on the keyboard, $ before the B and 15, because I don't want that tax rate to move when I copy it across, which I'm going to do. I'm going to copy this across, and that tax rate's not going to move. So I'm going to copy the 20,000, shift, and scroll on over to number 10. Oh, I messed up. I was trying to speak it, and then I messed it up. I won't do that again. There we go. And then it still got it right between 3 chances, though. So then let's go to the home tab, font group, and underline it. And then we've got the earnings after taxes calculated here this time. The 57,143 minus the 20,000. Let's give that a copy and a paste because that's the same all the way across. There we have that. Give it a good old copy and paste. Then we'll put the depreciation back in place. That's going to be equal to the depreciation. Copying that, pasting it all the way across. And that'll finally give us the cash flow, the flow of cash, like the lifeblood of the organization flowing through its veins, making it survive and thrive. So font group, underline, then we'll sum it up equals the SUM of these two. There we have it. And then I'll copy that and paste that across. So that looks good. All right, I think everything is proceeding forward as it should. Now we have, so you can see how you can have a complex, basically scenario, even more complex than this, what would happen from each year, and then you can basically get to the end of the day, cash flow per period, then apply the present value calculations. Note that as you do the present value calculations, we're kind of assuming this whole happens at the end of the year. That's how present value works. But, you know, that's part of the process. So now we're going to say, all right, now I got the cash flow. Now let's do the present value thing. We could do it vertically or horizontally here, or vertically. Let's start it with the horizontal, because you can kind of see how you might just continue on with this table, bring it on down, move it on forward. Note that I am going to have the years up top because I want to use those in my formula that will help me to copy it across. Very useful thing. So now I'm going to say negative, or let's just bring over the cash flows first, copying that across. So we have those in place. And then now this is where the action happens. This is where stuff's going down somewhere, downtown. So now we're going to say this is going to be the negative present value, shift 9, rate all the way to the left. And this is going to be then the discount rate, or the cost of capital, or the hurdle rate, or the required rate of return, whatever they want to call it, right? That includes what we're going to want in terms of our gain. So if we get to a number of 0, then we have cleared that rate and we may accept the job, possibly. So F4, that means a dollar sign before the B and 17, comma, number of periods is going to be that 1. Notice I'm picking a cell there and not putting a hard-coded number, not typing it in other words, so that I can copy it across and the cell will change when I do so. Then we'll pick up the number above it, which is going to be the 80,000. There it is. Let's do a couple more, and then I'll just copy it across. Negative, present value, shift 9, rate all the way to the left. It's going to be the 15%. F4, keyboard, making it absolute, comma, number of periods, 2, up top, comma, 2 commas, because it's future value, and we'll pick up the future value. There it is. Let's try one more here. Negative, present value, shift 9, rate, all the way to the left, 15%, F4, keyboard, $ B17, common, comma, up to the 3 for the number of periods, comma, because it's not an annuity, and then up once to the amount gives us the 54,815. So we could copy that across. I'm going to delete these two and just show that we can do this easily by just copying it across, because we set up our table in an ingenious way, very efficiently and well done, with the absolute reference being absolutized over here. So that cell won't move. That's the interest rate. Then we'll just put our cursor on it, fill handle, grabbing that, dragging it to the right, all the way to number 10. Does exactly what we thought it would. The very thing that we expected to happen, happened. So we're going to say this is going to be the sum of these on the left. And there's our total. And then we'll take the investment, comparing that to the money that went in. I'll make this a negative number all the way to the end, negative number. We put in the 300,000 to buy that thing that we're using to make us money. And we'll underline it and put the good old underline. This is the NPV, the net present value. Summing this thing up equals the SUM of those two. So it's a positive number. So that means that we did indeed clear the hurdle rate, which we would have done even if it was just 0. So we're looking pretty good. Let's do the calculation again the vertical fashion way, which is the way we've been practicing more. So this might look more familiar. We'll do this quickly because we've seen this pattern a few times. 1 and 2, or 0 and 1, I should say. And then copying it down. Alignment, center, total. And then we're going to pick up what we invested in period 0, 300,000. Cash flows. It's a little bit tedious to pick up the cash flows, but 80,000, enter. That's not enter. And then the 90,000 here, enter, and then the 83,367, enter, and then your 478,120, and then your 574,371, and then your 654,871, and then your 754,871, and then your 8. 5185, and then your 945.5, and then your 1045.5. Underline that, font group, underline it, sum it up equals the SUM. Sum. And there we have it. And that's what we would have if cash flows after the 10-year without present valuing. Now let's present value. Negative PV, shift 9, rate all the way to the left. 15%, absolute value, F4 on the keyboard, $ before the B and 17, comma, number of periods, 0, comma, and then the future value is the 3. Same number, but we should be able to copy it down and then different numbers will happen. So we'll autofill it, putting our cursor on that little square if I can, and then dragging the fill handle down. And then we'll underline on the down here, sum it up equals the SUM. And there we have it once again. All right. Then we can also calculate the IRR. We're saying this looks good. Let's calculate the because we cleared the rate, but let's see what the internal rate of return, the IRR, the is. So we're going to say it equals the IRR. And then shift, and we'll just pick up this series of payments right there and enter. And then we got to make it a percent. Number group percentize, add some decimals, make this fancy looking black and white, put it in its tuxedo colors. And then this one, we'll make that one here and put a little border around it. Very nice, very nice. Okay, so in other words, we cleared the 15%. We know that by the net present value being positive. And then we say the IRR, we're looking 20.78.